Welcome to Daily Drive for Monday, April 27th, 2026. I'm Kellen Walker in Las Vegas. Today on the show, Toyota posts record sales despite tariffs, thanks to hybrids. Nissan flips its financial outlook from loss to profit. And dealerships are losing service business to quick lube shops. Plus, Boston Consulting Group's Eric Jesse talks about how automakers can find white space to win in different powertrain segments.
You don't have to believe you need that much market share to get to a really meaningful amount of money to make it a profitable segment.
Let's run through all the news you need to know to keep up in the auto industry. Toyota is shrugging off the added financial burden of U.S. tariffs. The automaker just posted record global sales, nearly 11.3 million vehicles, even with a 15% tariff on Japanese imports. U.S. sales actually grew nearly 8% to more than 2.5 million. The secret? Hybrids. They now make up nearly 40% of Toyota's sales worldwide. While other automakers are nursing their EV wounds, Toyota's diversified powertrain bet is paying off. Nissan just flipped its financial outlook from red to black. Nissan now expects an operating profit instead of a loss for the fiscal year that ended in March. Credit goes to tighter cost controls and a favorable exchange rate. The company still expects a net loss of 550 billion yen. And global sales? They're down nearly 6%. Full results drop May 13th. And dealerships are losing more business to quick lube shops. New data from Ducker Carlisle shows dealership service transactions dropped 13% from January 2025 to January 2026, while quick lubes actually gained market share. Dealerships have been raising prices faster than their competitors, and customers are noticing. While almost every new vehicle comes with free manufacturer-paid maintenance for the first couple years, Ducker Carlisle says dealerships have been having a tough time retaining those customers. And those are today's headlines. You can find more details on all those stories at autonews.com. New vehicle prices have soared past inflation since COVID. A best-selling Toyota RAV4 now costs about $1,000 a month when you factor in the loan, fuel, insurance, and maintenance. In a new column, Automotive News managing editor Jerry Hirsch writes that automakers need to produce smaller, simpler, cheaper cars to solve the affordability crisis. He joins me now to talk about it. Jerry, welcome to Daily Drive.
Thanks. I'm glad to be here.
All right, Jerry. So what specific features or technologies should automakers strip out to bring these simpler vehicles to market at a price point that works?
I think it's really about prioritizing. So they have to have a automatic emergency braking and forward collision alert. That's a federal mandate. The rear view camera, too, is a mandate and is a basic safety feature. About the only other thing that I would include in terms of that, and maybe not even, would be the blind spot alerts. I mean, these things have all been proven to reduce crashes and they increase safety. So that's important. I get that. But after that, smaller appliance cars is what we need. This is what's going to happen, is that the Chinese are going to find their way into this market somehow. Right now, they're blocked, but it's going to happen either with factories that they take over here or some change in trade rules. And they're going to steal this low-end market from the automakers, which now is mostly fulfilled with used cars. So it just makes no sense for the automakers not to start producing a low-cost car to bring people into their brand. Another thing that they can do here is to say everybody is so used to their phones, Android Auto and Apple CarPlay. It has all the infotainment you need. It has navigation. These phones have just about everything on it. If you're driving in an urban area, they work perfectly well. There's almost always connectivity. There might be some spots in very rural areas where you lose connectivity, but just leave the infotainment to the phone developers who do a much better job than the auto companies. And you take all that content out. You don't need to charge for it. It's just the interface.
Well, this all seems, Jerry, pretty straightforward. Now, why aren't we seeing automakers take this approach already?
I think it's really a quest for short-term profits and or near-term profits that they have gone through this period where they invested a ton of money in electric vehicles, electric vehicle batteries, and then in self-driving technology. I mean, both Ford with Argo AI and then GM with Cruise. They thought that they would have these robotaxi companies, these autonomous vehicle companies. Turns out others like Waymo are doing it better. And then we have these startups, Zoox and Hyundai's Motional, that are approaching it. And so they spend a lot of money on this. So I think they're just saying, oh man, we've made the wrong bet after wrong bet. Let's make right bets. Let's please our shareholders. Let's be profitable. Look at the write downs that they've had for electric vehicle technology. I think it was, if you look at all the legacy automakers, something like 60 or $70 billion. Look at the money that they've paid so far this year that we know of on tariffs, something like $35 billion. So these are huge drains. So they're doing the thing that seems to be safe. Make big profitable vehicles that consumers love in the US, but they're going to price themselves out of the market. That market will be satisfied by others. I mean, that's part of market-based economies.
Perfect. Jerry Hirsch, very insightful. Thank you so much for joining me.
Glad to be with you.
Automakers are crowding into the same segments, chasing large pickups and mass market EVs. But Boston Consulting Group says there's a smarter strategy. Find the gaps where you can be first and face fewer rivals. Eric Jesse is managing director at Boston Consulting Group. He spoke with Automotive News deputy editor and electric vehicles reporter Lindsay Van Hully on the latest episode of the Automotive News Shift podcast about how automakers can identify and win in these white space opportunities. Here's a piece of that conversation.
Eric Jesse, thanks for joining us today.
Thanks, Lindsay. Pleasure to be here.
So you're a co-author on a new report that looks at growth and profitability opportunities for automakers as the industry's electrification transition continues to unfold. What prompted you and your colleagues to write the report, and what questions were you interested in exploring?
Yeah, so a lot of our clients have been struggling to figure out how to position their portfolios to make money. And this is both the OEM side, but also the suppliers that work with them. And so there's just a need to figure out what the right plays are against kind of a multitude of outcomes that leave them profitable. Where if they overinvest in one place, like it can go really far south really quickly. But if they underinvest, they're gonna miss the opportunity to participate meaningfully in the future.
What's been kind of leading into that struggle, to kind of figure out where to invest? I wonder how important this type of product planning becomes when you have, so many different changes we've seen in the market, from EV regulations to tariffs. We know costs are going up and profits are being squeezed. And I wonder how much of the kind of big macro factors are part of this discussion.
I mean, I think they're core to it. I would say the biggest piece for most of them is really how fast does electrification happen? And so there's really big and meaningful investments that go with that. As you leave and transition from ICE, the portfolio where they're really well rooted, they're way down the learning curve, the whole kind of machine is built around that, to a new world that is very much, going to be electric vehicles at some point. And that requires a whole new powertrain, a different form of factory to set up those batteries and how they move in that direction. And so you're actually transitioning profit pools. And so how you set up against those are really important if you think about the fact that a powertrain is easily $1 billion investment if you think of the whole platform through in the case of an EV.
And I think that's an interesting point, because you and your team argue that, the best profitability opportunities and growth opportunities aren't in chasing those kind of fastest growing or biggest segments, knowing that electrification journey is going to unfold just maybe at different speeds than people thought initially. But the bigger key really is exploring those white space opportunities where there are fewer competitors. And I'm wondering if you could talk more about why that is and what you're arguing there.
Yeah. So I guess taking a step back, the thing to appreciate is that like a EV company, a pure EV startup is making one bet, right? And they have no IP that they can rely on to make money in any other way. So it's like a make or break scenario of like how they go all in. There's a reason that so many of them have gone bankrupt. If we think of our traditional OEMs and the suppliers, they've been making money for a long time. And as a result of this, like they actually have this huge background of IP. And that IP plays in spaces that can be really profitable. And so what you can do with that is in many cases, you don't have to exit, right? Or you can extend into a different segment at a much lower cost than an EV upstart. It would literally be unapproachable to them in many cases, right? Like you're talking about an internal combustion engine, you're talking about electrifying parts of that internal combustion engine in the case of hybrids. And the reality is like that hurdle of the first time investment is much, much bigger than the idea of taking a powertrain and say shifting it into a new segment or taking a vehicle and crossing it into a segment if you can reuse that platform there. And so because you have that lower hurdle, right, your profitability in that segment, because you have that IP route, can be dramatically lowered. And therefore, it can be very interesting for you to maintain that position, especially as these segments become less competitive, right? Like the refreshers are changing, the technology investments to continue participating are slowing. And so it can actually make the whole economics tilt if you're coming in from a place where you have technologies you can bring to bear.
That it gets you there maybe faster and at less cost.
Yes. Simply said, that's probably a better summary.
And on that economic point, you think you noted that, those faster growing segments, they're going to require more upfront capital investment, maybe more incentives if there's more competitors in that segment. But those that are kind of growing at a slower pace, especially around EVs, can be more favorable on the economic side. I think you kind of talked about that a little bit, but maybe expand on it and kind of why that dynamic is. When you're in a place where it's growing quickly, it seems like that's where the customers are. Why would it maybe not make as much sense for them to jump into those segments from a financial aspect?
Yeah. So every auto OEM is looking to have like the superstar of a segment, right? Or to hit like a hurdle that breaks even. So 100,000 units a year in a segment is break even-ish. And then above that, you start to make more and more margin. If you play in a big segment, like you can get 1 or 2% or 3% market share and make it to that hurdle. However, if we think of like a mid-size SUV, you're probably competing against 40 or 50 players. And so like maybe like your odds are reasonable in that sense. And like you could see a line of thought where you'd get there. There are also segments that are smaller, right? Like sedans are shrinking, for example. But the number of players is like dramatically reducing while there's still quite a meaningful amount of volume there. And so if you have a sedan and you have a hybrid, the ability to play there where you're playing against maybe 3 to 5 players and still hitting that 100,000 mark or maybe 80 or 60,000 mark because your investments are so much lower, can become really feasible if you have the right starting point. And so like you can make those trade-offs. So it's like, do I want to compete against 50 people or do I want to compete against 5 people? And so you just need to figure out like, is it a 50-person cake in both of them or like a 10-person cake in both of them? But 10 divided by 5 is better than 50 divided by 50.
And you gave a couple of examples, I think, in thinking about how to walk through this sort of scenario planning. And one of them was mid-size pickups. Walk us through that scenario and kind of explain what it means for automakers, sort of on the ground as a practical example.
Yeah. So mid-size pickups have been like a well-protected space, right? For quite a bit. Like there aren't a huge number. It's pretty well dominated by a couple players right now. You actually saw some people leave and come back, and there were like economics in the decision to come back, right? Which was they had platforms and they can move in. It's not as big as the full-size pickup segment, which has more players in it. So if we look at that mid-size pickup segment, what you could see is like under certain situations, it'd be really hard, right? So if you're engineering your first pickup platform, you're engineering the engine, it's really hard to come into this segment and say, hey, I'm going to do great. Whereas if you have the powertrain or you have the chassis, right? Like you could look at this segment and say, hey, it's not as big as the full size, but there's less competition and I can get into it at a reasonable amount of investment. And then dividing this against the handful of players that are there can become really interesting, right? Like you don't have to believe you need that much market share to get to a really meaningful amount of money to make it a profitable segment. Especially if you look at the white spaces within that segment, like there's very limited hybrids there. And so like there's a niche to go in and play, and that's true for other segments as well if you look around the space of the US automotive landscape. So it was a good example.
And that example, I think, dovetails on another scenario that you were kind of outlining here, two kind of possible options. The idea of, a full EV tipping point coming quickly and, hybrids surging for a while as full battery electrics take longer to materialize. I want to get back to the midsize pickup example, but I want first to see if you can kind of walk through those two scenarios, those possible outcomes and what that would mean for automaker profitability and portfolio decisions.
Yeah. So BCG has been working for quite a while on like how fast the tipping point will occur. And so there's always been somewhat of two camps of, hey, it's going to convert really fast because of TCO and policy that supports it and how we reduce the cost of these vehicles. And then there's the other camp that takes a view like it's going to be hard to get consumer adoption. People don't like change. They have these things they know. There's a whole bunch of infrastructure investments that need to occur. And so it goes slower. And I think that even over the past 2 years, we've seen it go from, hey, we're going full speed towards EVs to the credits have gone off and it went the opposite direction to now with oil prices going back through the roof, people are reopening to the idea of EVs. And so in analyzing the scenario, like we took two likely outcomes of the world, a slower kind of adoption where people do become more fuel sensitive right over time. And so that leans more towards a world with hybrids, or a world that could be more policy driven or much higher oil price driven, where we shift further and further towards EVs. So like the more aggressive transition. And so if I was advising any OEM, we'd probably look at those as the two most likely. And we may even go further out to either extreme in some cases, but it's kind of like the right planning bookend of, if you're successful under both of these, you're going to be successful. That's kind of the end outcome and why we thought it was the right kind of bookends to tell the story around.
Eric Jesse spoke with Automotive News Deputy Editor Lindsay Van Hully on the latest episode of the Automotive News Shift podcast. You can hear the full conversation on Shift, available now wherever you get your podcasts. That's Daily Drive for today. I'm Kellen Walker. Thanks to Automotive News Executive Producer Jake Neer, as well as our own Hans Greimel and Alicia Webb for their reporting for today's podcast. You can get the latest news on product strategy, vehicle affordability, and everything happening in the auto industry at autonews.com. Come back tomorrow for a conversation with Wide Whale's Kyler Owens about why 41% of the top 150 dealership groups generate more bait and switch complaints than the national benchmark and what dealerships can do about it.
4% of the negative reviews that come in reference bait and switch or imply bait and switch. 11.6% reference honesty as a negative faction of what they're talking about. And obviously that ties into they've said one thing and then did another.
We'd love to hear from you. Let us know what you think of the show and the topics we covered today. Send us an email at dailydrive@autonews.com or leave us a voicemail at 313-444-2774. And if you enjoy the podcast, remember to like, leave a review, and subscribe so you never miss an episode.